So the way we run our portfolios currently, we have a core scenario like this. This pullback was, by the way, something to be expected. It has been a long time. So we want to use the pullback, as an opportunity to increase risk again, coming into the fourth quarter where seasonality is expected to be better. But that being said, we continue to run very balanced portfolios. As mentioned before, you get compensated on the cash, you get compensated on the bonds. So you want to be well diversified and look at the price you pay for equities. You were talking about this UK stock before trading at 10 times.
Yeah.
If you look at the whole market,
advocating buying it, I'm just saying look at the price compared to other markets.
Exactly. But that is what is happening, outside this magnificent 7. If you look at the MSCI EFI PE, we are talking about 13 times, 1-3. If you look at the S&P 500 X, the top 7, we are talking about 15 times. So it's not an outrageously expensive market. So you need to be, look at your stock picking and then rebalance maybe your equity portfolios, from being just on these top 7 into some of the laggards. And I think if you build your portfolios in such a diversified way, you have, let's say, a portfolio which can be tested into more difficult situation. Again, our core scenario is use a pullback for potentially, let's say, a run at the end of the year. But the more the bond yield is rising, the higher the risk of a financial accident. The CEO of Bank of America was saying soft landing. If you go on Google Trends, soft landing is going to the roof. Everyone is Googling soft landing. That's the consensus. But we know usually what happens is that macro is not driving the markets, it's that the markets are driving macro. So if there is any financial accident, this soft landing, Goldilocks, wishful thinking will be tested, and we might, let's say, reprice the risk of something which is different than a soft landing.
So where could an accident come from? We've been talking about different factors, the looming government shutdown, why this time could be different, the bets in the treasury market, for instance. What could be a trigger this time around for an accident?
At the same time, oil prices moving higher, long bonds moving higher, the dollar moving higher. You are creating liquidity conditions which is tightening, in a considerable way. There is still a lot of debts, there is still a lot of leverage in the system. So the more, these financial conditions are tightening, the higher the risk of some kind of accident can happen. It could be a hedge funds, it could be a sovereign, it could be a corporate, it can be many things.
I want to pick up on your point too around the seasonality and how this is changing, things are getting better. So shrug off September, we knew it was going to be bad anyway, just shrug it off.
Yeah, but then October can also be, can also be kind of challenging. But we know that usually the last 100 days of the year is the best season. It's not a golden rule, but 80% of the time, the last 100 days of the year are nicely positive. So let's keep this optimistic note.
Okay, so cancel the ski trip and look for the Santa Claus rally already. I think it's the first time we've mentioned it so far in 2023.